6 months ago I said not all retail is created equal, and that's very true, and our results are very different from what's happening in shopping centres. But my quote for today is large format retail equals large format returns. Hopefully you like that one, Fiona. And why I start with that is we are very proud to say that we've had a total shareholder return for your investors that would have put in $1 in January. They would have had a total shareholder return of 44%. So we're one of the highest performing and the best performing and the most consistent of all of the real estate investment trusts. Our property, this fund is backed by hard real estate. It's not revenues, there's no cash burn. This is real sustainable rental income streams. We've been doing this for 16 years. We have $2 billion worth of large format centres, and we have no fashion, we have no department stores, and we have no discount department stores. So some of the risk and the pain that you're seeing at shopping centres, we're not actually experiencing in large format retail. Just a headline for investors putting in money at today's share price, you're getting a solid return, one of the sector high leading returns of about 5.75%, so about 5.8% on today's share price. Quarterly distributions as opposed to 6 monthly distributions, and tax deferred of about 40%, so very healthy tax deferred. 3 highlights I want to talk about today is firstly our sustainable income growth. So as Fiona said in her note out to all of the brokers, Aventus again led the way with sector high leading net operating income growth of 3.1%. The average for our retail peers is about 1.5. So we're basically doing double what the actual sector is doing from a growth perspective. So that's because of our compounding fixed yearly increases in our leases. So 74% of our leases have fixed annual bumps of 3 to 5%. So we're just getting that constant growth. Our occupancy remains high at 98.6%. We're achieving positive leasing spreads and low incentives. So another shopping centre fund recently said that their incentives are 15 months on a 5-year deal, which on the mass is about 20%. Our average incentives are less than 5%. So our rents are sustainable and low. Our average gross rate per square metre is only $317 a square metre, but shopping centres are basically 3 times the rent compared to large format retail. Our average occupancy cost is 10 to 11%, and again, shopping centres are sitting at sort of 15 to 20%. So sustainable, resilient income growth. Second highlight for Aventus for this last 6 months is our balance sheet. So we restored the flexibility. We reduced our gearing by 3% down to 35%, which is in the middle of our self-imposed gearing band of 30 to 40%. We did that with a couple of techniques. So we underwrote the dividend reinvestment plan. We did that twice and raised about $46 million at only a slight discount to the VWAP at the time. And secondly, we started a funds management business. So we kicked off our first property syndicate for the last 5 years, and we brought in a cornerstone investor. Aventus owned 25% of a particular property, and we raised funds for 75% of the balance. So that allows us to diversify our income streams and allows us to tap other sources of capital and other pools when the listed market is not actually working. And on a third basis, we upgraded our guidance. So we told the market that we were going to do between 3 to 4%, and we upgraded our guidance to be basically at the top end. So we are now saying we're going to be 4% FFO growth, which is 19.2 cents for the year ended 2020.